Hello, this is Jared with the Helton Group at Loan Depot, and I'm here to lend some more knowledge on the WTF series. This is the third part in the series, and in this series you'll learn about what makes up your credit score. So your credit score, you got 100% of what your credit is. There's different sections that are weighted differently. So 10% of your credit score is basically on new credit. So that's inquiries, recent accounts you've opened up. There is a little bit of myth that multiple inquiries will hurt your credit score. One of the things about mortgages is if you have multiple credit inquiries, it's called deduping. It only counts as one. You even have 2 or 3 or 4, and that's they kind of take that out whether between 14 and 45 days depending on the credit scoring model. But I get that question all the time, so it doesn't hurt to get a second opinion for sure. And then the next is 10%, which is basically your credit mix. So credit mix would be types of finance accounts, revolving accounts, installment loans, mortgage loans, auto loans, kind of your overall mix of it. Not a lot you can do on that to fix it anytime soon, and it's really a small percentage, so I wouldn't put too much attention towards that. Next is your length of credit. So your length of credit, if you think about that, is how long have you had credit cards established, or how long have you had accounts established, your oldest account, your newest account. That really, that's 15%, but also the 10% for, basically new accounts, it can kind of double ding you there, so you have to be really kind of careful on that. I would say that one of the things I would recommend to people is if you have older accounts, sometimes keeping those open can kind of help you, but in closing a bunch and getting new ones can hurt. So you just have to think about those things. It doesn't mean that you shouldn't do that. It's just something you should think about. And also, there's still a little bit of a loophole. So if you have kind of newer credit and you're younger, maybe you don't have seasoned credit, you can kind of almost borrow that a little bit, because you can be an authorized signer on maybe a parent or a co-signer's account where they've had that account for 5 years, and you can kind of automatically get that 5 years worth of history. So there's that's something to think about. It doesn't fix everything, but it's just something to think about. And then the other 2 categories are probably the most important. You have 30% of it is the amount you owe. So this would be how much you owe on your installments, how long they've been open versus what you owe now, especially on revolving, your percentage of utilization. So if you owe a higher percentage of what your balances are, it's going to have a bigger impact on your score. That's where we see where a lot of people can improve their credit, whether they have good credit or bad credit. That bucket is kind of the main one. And the last one is the most heavily weighted. It's 35%. It's payment history. So this one kind of makes the most sense. You pay your accounts on time, you're going to have better scores. If you have late pays, it's going to have worse scores. They're not all equal. A mortgage late is going to have a much bigger impact on your score going down. And then also you have things like derogatory credit, public records like bankruptcies and judgments. Those also affect them. So a lot of it is on how frequent they've reported. So if you have something that's reported last month, it's hurting your credit score. If you have something that's negative but it hasn't reported in 4 years, it's not going to hurt your credit score that much. It's very individualized, so we need to come up with a plan for you. And that's what you can learn in video 4, is kind of coming up with a plan and what do you do next. So as always, you can DM me, you can call or text me at 541-870-8913. I look forward to talking to you in the next video series on WTF and lending some more knowledge. Thank you.